Well, good morning everyone, and welcome to the Magellan Global live stream. What really matters in investing, finding quality through the noise and hype. My name is Mark Burgess, and I'm the Head of Distribution and Marketing here at Magellan, and it's my great pleasure to welcome you here today. It's also wonderful to see so many of you joining us with over 1,540 registrations online. Today's webinar is aimed at providing you and your clients with our most current up-to-date views of the investment landscape and how we are positioning the global equity strategy as we look forward. You'll also have the opportunity throughout today's session to submit questions. We've already had a number of pre-submitted questions, and so thank you for that. And if you'd like to submit a question, simply click on the Q&A box on your screen and those questions will come through to us. So the format for today. Well, in a moment, I'm going to invite Portfolio Manager and Head of Macro, Arvid Streimann, up, and he's going to talk through the current market conditions and what impact this has in shaping the portfolio. Following Arvid, he will hand over to Portfolio Manager Nikki Thomas, and she will discuss in more detail some of the themes that are running throughout the portfolio. We will then have one of our sector specialists, Emma Henderson, come up and talk through from our franchises team who'll talk through some of the compelling opportunities that we see in the global restaurant space. Talk through some of the companies that we own and their role in the portfolio. Finally, my colleague and Head of Retail, Mark Jordan, will facilitate your questions through an open Q&A session. Well, that's enough from me. Please see on screen the disclaimer for today, and please welcome Arvid Streimann to the stage.
Well, thanks, Mark, and thanks everyone for tuning in today. I'm going to talk about the macro outlook. I think it's really important to understand where we're seeing the world because it has some very large impacts on how we're positioning the portfolio. So let's get to it. The first thing I want to talk about is the growth and inflation outlook. And for a while now, we've been positioning the portfolio for a soft landing. And the reason why that's important is because of a soft landing is not a bad outcome for markets. And this is the reason why our portfolio is fully invested, okay? We'll get onto the shape of that investment later, but the portfolio is fully invested. I want to talk about a few reasons why. On the screen in front of you, you can see that the economic data, leading indicators of the economic data, basically where the growth outlook's going to go, they've deteriorated, no surprise there. But if you look at the chart and you look at the highlighted parts of the chart, which are recessions, you can see that it's not pointing to something which is a severe recession. It's pointing to a slower slowdown, and it's nothing like what you saw after the GFC, and it's nothing like what you saw after COVID. Now, this is something that hasn't really changed our view, so we've been fully invested for a while, but it's important to note that things have actually slowed a little bit. Okay. Now, turning to inflation, this is the middle part of the chart in front of you. Inflation as well has slowed, and we've held the view for a while that inflation was going to slow because at the end of the day, inflation had risen because there'd been a positive demand shock and negative supply shocks, and we expected both of those to be ironed out over a period of time. Now, that stuff is actually happening, and when thinking about inflation, you can see the line there has come off a bit. We expect that to continue to slow, but in a slower pace, so to speak. Now, the recent data flow, consistent with what I was showing you in that first chart, is consistent with the picture which I just painted, and that's good news because if it wasn't consistent and those two charts were giving you the opposite messages, then I think the world's in a bit of a problem because you don't know what is going on, investors and also policymakers. Now, when we're thinking about inflation, which of course isn't going to decline in a straight line, nothing in the world moves in a straight line, of course. When it comes to inflation, one of the big risks is that someone or workers in general say, hey, you know what, my cost of living has risen by around 10%, and I'm going to ask my employer to give me another 10% wage increase so that I've got the same purchasing power as I had before. Now, the chart on the right-hand side shows you the amount of firms which are going to, or at least planning to, increase their compensation. And you can see that that chart as well has actually, that line has actually decreased. Now, all three of those lines have decreased, and I think that's good news for the global economy. It's good news for the soft landing, and it's also good news for equity markets, and we all know that equity markets have rallied. Okay, now I'm going to talk about some of the risks, and the reason why the risks are important is because, as I said, we've got a full equity risk appetite at the moment, but that shape of that risk that we're taking on in the portfolios, it's very nuanced. There are some risks that we like and some risks that we don't like. Okay, so now I'm going to talk about some of the key risks, and I think you can break these into two types, okay? The first type of risk is from higher interest rates, and the second type of risk is if there is man-made negative supply shock. And a negative supply shock, if you think back to Economics 101, if you were lucky enough to do it, means higher inflation and slower growth, so like a recession. So if we start with some of the key risks around higher interest rates, now we don't know what the ultimate impact of higher interest rates is going to be, okay? We can all have our predictions about it, but no one actually knows. We know that in Australia, a lot of people with mortgages are coming off fixed rate mortgages and they're getting rebased to higher interest rate mortgages, and that's going to have a negative impact on growth. How much of a negative impact on growth, no one really knows, and you'll probably find out when you're there. But there's a similar dynamic which is occurring around the world, and until we get a greater clarity on that, we won't actually know what the lagged impact of higher rates is. Okay, so that's number one. The second is financial system instability, and here we have actually seen this play out a couple of times already, okay? We've seen it in the UK, we've seen it in the US, and I would say we've also seen it with, in Switzerland with the Credit Suisse. Now, I would highly doubt that that financial system instability which occurred would have occurred if interest rates hadn't have risen. And as we all know, interest rates are still high, so this risk is still out there, okay? And if it comes true, that'll be not so good for the global economy. Of course, we've been through that during the GFC. Emerging markets are always a source of potential risk, downside risk when it comes to higher interest rates. History shows that. That's something that we're watching as well. But I don't want to be all negative here. There is a positive here, which is that perhaps the central banks around the world, the Federal Reserve, the Reserve Bank, maybe they actually do successfully slow economies and reduce demand such that inflation is reduced and we don't have a mass increase in unemployment and a mass decline in profits as well. That would be the good outcome, and that's potentially a case which could occur. Now, the second type of risk that we're facing are man-made supply shocks, and I'm not going to talk about the non-man-made ones. They're very hard to predict. But man-made supply shocks, we all know that the world is decoupling. Some of the trade relationships around the world are being, let's call it, readjusted. Now, I kind of think about this as similar to if you're driving. If you start to drive faster, the risk of an accident goes up. So decoupling I don't think is such a bad thing, and trade diversion I don't think it's so much of a bad thing. But if it happens really quick and it's out of control, that's when the risks go up. So that's essentially what we're looking for here when we're thinking about some of these decoupling risks. Of course, Taiwan's been in the news as well. It's not our base case that China makes a move on Taiwan, but if it did happen, I think a lot of people would say, well, that was always on the radar that it could happen. Something that we follow. It's not a unknown, so to speak. This is a known unknown. The Middle East, throughout history, has always been a good source of negative supply shocks for energy, and we follow that very closely as well. And of course, we all know that despite the fact that reliance on carbon-intensive forms of energy has been reducing, it's still high. Okay, so this is why the Middle East is still relevant from some investment perspective. Of course, regulatory crackdowns, to the extent that they impact what firms produce, could produce a negative supply shock. We're watching that really closely. We've seen some of this stuff happen in China and potentially also in the US, although we've been monitoring that for a while. It hasn't really happened, but it could happen, of course. Now, don't want to be all negative again. What's a positive? Now, there is technological advancements which could materially improve productivity, which would be a real positive here, okay? And we're going to talk about some of that later on today. Something to watch. Now, I want to talk about earnings. And here, earnings and profits, they're the same thing. And we showed this chart during November 2022's global webinar. So it's exactly the same chart. And what it shows you is analysts, stock market analysts' expectations of profits over the coming 12 months, okay? And the bars on the chart show you periods of where the Federal Reserve was tightening. And we made the point back in November last year that we didn't quite know where profits would go, because if you look at that chart, I'm going to click forward here, if you look at that chart, after all of those previous periods of tightening, you, in most cases, you had a reduction in profits. Which would obviously hurt stock market returns. And in some cases, it was quite material. You just look at what happened after COVID, you look at what happened after the GFC, and to a similar extent, you saw what happened after the dot-com boom of the late 1990s, early 2000s. Now, at the time, we said, you can see the question mark, we said, we don't expect there to be in our base case, a material reduction in profits, and that would obviously weigh on markets, because you need one of two things to occur for there to be a collapse in profitability. One is that maybe there's some asset price bubble which is bursting, and at the time in November last year, we were of the view that there were pockets of the market were overvalued, crypto, some speculative equities, but it wasn't broad-based and it wasn't debt financed, okay? So that was less of a concern for us, one of the reasons why we thought there was going to be a soft landing. The other was, well, maybe something does happen, okay? There's always things that can happen which can shock the world, shock the system, and that was some of the things that we talked about earlier on the previous slide. Maybe that's going to happen. Lucky us, I'm going to fast forward onto what's happened since November last year. Nothing's really been a big negative shock. So lucky us. And so analysts' expectations of profitability, which in turn drives share market performance, has been relatively flat. Some people thought it might slow down a bit faster, but at the end of the day, it's been relatively flat. And I think this is one of the reasons why markets have actually rallied quite significantly, because that tail risk of a negative reduction or a big negative reduction in profits and growth has lessened. So when we look forward, we see growth slowing, and so we would expect the earnings outlook to not, that line not to increase materially, because there's going to be this headwind from growth. But at the same time, we don't think it's going to be like one of those big collapses that you saw in the past. And that's also why we are fully invested. Okay, so now I'm going to talk about where we see markets going, because that has a material impact on how we're thinking about the portfolio and its positioning. Now, markets are complicated and they're moving around a lot, but I want to tell you there's really only three things which drive markets. Profits, and we just talked about where profits have been in the past and our outlook for profits. Interest rates, which we've talked a lot about in the past, and I would say those first two things are fundamental, okay? They fundamentally impact the value of a security or a value of an asset. The third driver here of stock market returns, which is sentiment, let's just say it's not so much fundamental, it's just how much people want to pay, okay? Holding those other two things constant. Now, we've actually estimated what the contribution of these three drivers are, or have been, over the past 20 or so years. And you can see that in the chart in front of you. It's all color-coded. You should be able to see that. Now, when we look at that, the first thing you'd be able to tell is that there is no one driver which consistently is a very big bar to the positive or negative, okay? It's shifting contributions from these three factors. And if you look around the GFC, you can see in 2008, sentiment really took it in the neck. It was very negative. It dragged on performance of the stock market, but then it rebounded in 2009. And this is kind of consistent with how we would remember this episode. Of course, profits went down over those 2 years, which limited how much the market went up. But you can see this decomposition in action. I think this kind of makes some sense. Now, if we look at what happened last year, I just click forward, you can see that there's a little circle around last year and the yellow interest rate bar, column I should say. Now, last year, we all know interest rates went up, and we'd positioned the portfolio for that because we had a high level of conviction that interest rates were going up, so we were trying to manage our interest rate risk. And you can see that the size of that drag from higher interest rates was larger than it's been in the last 20 years or so, and it actually dragged down overall returns. And so I think this is one of the reasons why this so-called 60-40 portfolio of equities and bonds didn't perform as well as it has in the past, because that rise in interest rates was just so big. Now, if we fast forward to today, I'm not convinced that interest rates are going to rise to the same extent as they have before, in particular last year, because the Federal Reserve and the Reserve Bank here in Australia, they've more or less signalled that they're most of the way, if not all of the way, we'll find out, of the way through their tightening cycles. So what's going to drive share market returns going forward? Let's call it in the next 18 months or so. Now, so far this year, this is year to date, so this is from the start of the calendar year, it's actually been improved sentiment. And I mentioned earlier what one of those drivers, what has driven that improvement in sentiment. A lot of people saying, hey, you know, the economy hasn't blown up so far, so I think that this probability of a soft landing's gone up. I think a lot of people have said that and are thinking that, and you know, by the way, it's true. Separate question as to whether they're paying too much for that or over-assessing that likelihood. But if we're thinking forward and we go through these three drivers, profits probably going to be flatlined, okay, because there's a headwind from what the central banks are doing to slow growth. Interest rates, well, the central banks are more or less towards the top end of their tightening cycle, and sentiment already run. Okay, so I suspect here that maybe markets will be a little bit range bound in the next little while. But when we're thinking about overall averages, you can say that that picture that you've talked about, Arvid, is all makes sense. But remember, this is the overall market, and within the market, there are some stocks which are unloved and there are some stocks which are loved, okay? Maybe a little bit too much. So I think you can't get carried away with overall market averages, but I think this framework is really interesting to figure out and explain what's been happening to markets, because I think you really need to know what's happening in order to figure out where the market's going to go and also where stocks are going to go. One last thing I'll say on this slide, is my second last slide, is that if you look back over the past couple of years since COVID, it's been a very macro-driven market. You've had COVID, you've had higher interest rates. If we're right and the macro influence on global equity markets is starting to wane, then I think it's going to be more of a stock-picking market than a macro market. And that's certainly the way that we're thinking about things. So I want to wrap up here. There's 4 investment implications which I think we need to take away, and this is certainly what we're thinking about when we're constructing the portfolio. We're fully invested, as I mentioned, because I don't think that a hard landing should be in people's base case. It's a risk, but it's not the base case. I think quality is going to win, and here, when the going gets tough, I think the tough are going to get going, okay? Now, when we're thinking about economic upswings, you typically see lower quality companies really outperform, okay? And the reverse is also true. When you go into a more challenging economic environment, it's usually those high quality companies which tend to do the best. And importantly, they tend to do the best on the way out as well, because they invest through the cycle when maybe some of their competitors didn't. That's one thing that we look for from a stock selection perspective. Now, with slowing growth, I think number 3 here is that there's going to be headwinds for economic cyclicals. I think this kind of makes sense. And this is one of the reasons why we are not invested in any banks at the moment. Banks are quite highly reliant on the economic cycle due to their loan losses or exposure to loan losses. And the last thing I want to say here, the fourth and the last thing I want to say here, is that we prefer structural growth for a couple of reasons. Firstly, because they're less attuned or impacted by what's happening to the economy, because they're a structural growth story. And secondly, you can have a higher level of conviction in picking these long-term trends. You just have to look out the window sometimes to see them, and they don't change that much. So if you're investing with conviction, finding these long-term structural trends is actually something which is an area where you can have a high level of conviction as an investor. Anyway, that's it for me. I'm going to hand over to Nikki now.
Cheers, mate. Thank you. And let's jump right in, and I think we'll just follow through from what Arv's just been talking about. So just to start off, let's frame up the global equity strategy and to remind people, ultimately what we're trying to do here is deliver people an absolute return around that double digit through time. And we think about this from a couple of perspectives. On the left is all about finding the return ideas, but on the right, we're talking about this minimising the risk of a permanent capital loss. And this is absolutely central to how we go about this strategy to deliver on that absolute return mandate. So we have a dual sleeve portfolio construction for inbuilt resilience. when those event risks happen. We constrain risk, so we never take as much risk as the market in this portfolio. And we do a lot of work to make sure we screen out anything that's inferior quality or riskier, so that we're leaning in on that high quality piece that we can build those compound returns on. I love this slide. It talks to the pieces of the puzzle that sits inside our portfolio and the stuff that we get really excited about. I'm just going to focus in on two today. One is the top right-hand bucket on generative AI, all new and exciting, and the bottom left, really around what's happening with the adaptation of global infrastructure. This move towards a new energy environment, towards net zero around carbon. Our colleague Em is going to come up after me and give you some great insights around that very resilient piece of our portfolio, and in particular some of the restaurant stocks that we have owned for a long time and continue to own and continue to be very excited about. So let me talk about these two exciting opportunities. You know, there's one thing about my job. If you're deeply curious and if you like intellectual stimulation, this is a job for you. These two things are going to profoundly impact our world that we are living in for the next few decades. And it is going to change before our eyes. So we are deeply curious about how this plays out. But from an investment perspective, how do we leverage this to create extraordinary returns for our investors, but do it in a way that we don't take too much risk? Let's start with the explosion of generative AI. And I'm going to build here to show you the companies that are enabling and have enabled the generative AI, generative artificial intelligence piece to come to life. So two pieces really start with the framework and the foundation for this. One is a product that's called a transformer. It was a novel neural network, think like a little brain, that Google Brain invented back in around 2017. Now, prior to them, we've had lots of AI. We have lots of AI in our lives today. When you put Google Maps up on your dash and it tells you there's a better route to take. When you're watching Netflix and it says, why don't you watch this or this? When you're on social media and it shows you things that it thinks you might be interested in, that's all artificial intelligence working underneath the hood. But generative artificial intelligence is that next leap forward. So the transformer architecture is the foundation of large language models. And large language models have been enabled by massive data sets. All of this data of us interacting with the internet via our mobiles and other platforms has been collected and stored. And being able to mine that data with increasingly powerful technology is how you get to the point where you can move towards generative AI. So you need these things to have happened. Transformer technology by underneath Alphabet in Google Brain. We need to have the cloud and software ecosystem. So think about the hyperscalers here, Amazon's AWS, Google's cloud business, Microsoft Azure. These are the key players in that background of being able to enable the supercomputing, the accelerated computing that allows us to get down this path. Then we have the chips. So again, you need more and more powerful chips for this actually to be capable of extracting the information and the machine learning that we're looking for. So NVIDIA, as everyone knows, has been leaning right forward on the GPU's part, but there's lots of other custom chips and that acceleration of chip capability. So the AWS Graviton, the Apple M2s, some of the stuff that Google are always building, of course, they are probably the father of AI, has been enabled by Moore's Law, and the enabler of Moore's Law is ASML, a company in our portfolio, because it is virtually the monopoly in delivering the technology that allows us to make smaller, faster, more powerful chips. So EUV technology is kind of their most important piece of the puzzle, but it's about power and compute intensity and data sets and then large language models. And ultimately, we're now in this path where generative AI is surging forward. The piece we haven't discovered yet really is that next leg up. how do we commercialise generative AI to make money inside of these companies? There's one company that's been right out in front so far, and that's Microsoft. So we're going to talk a little bit about Microsoft and show you how they've started to commercialise this. But the pathway is well in the future. 365 Copilot inside of Microsoft is one of the ways. SAP, Intuit, these are companies with large data sets, and in the case of Intuit, has its own large language model working inside. So this is an explosion that started to come forward, and the possibilities are enormous. But don't think about next year or the year after. Think about in a few years' time and over the next few decades. And Microsoft absolutely are leading the way at this point, but there'll be lots of others. Remember, with technology, it tends to be an exponential story. It's not linear. And so that's what we've got to think about. Our brains tend to think in a linear fashion, but with technology, you have to think about exponential growth. So these next couple of things are going to just give you some insights on Microsoft itself. On the left-hand side here, I'm just showing you really the piece inside Microsoft that's about the cloud. You've heard us talk about the cloud inside of Microsoft before. It's about half of the business. We think it will grow at 25 to 30% per annum. And so even if the rest of the business didn't grow, you've got a company that has revenue growth that's around 15% per annum. And you can see here how we're getting those numbers, and a lot of it is about that basket of opportunity that sits with Azure. Now, we've talked about workloads going from old storage systems to the cloud, and that being a really big driver of this. But Gen AI is obviously creating a whole new swathe of workloads that will end up in these clouds. And so we're not even trying to put that into the numbers at this point. It's very hard to scale, but we know it's going to be additive. The piece that's kind of really interesting at the moment is the other half of Google, the kind of subscription piece where you and I buy our Office 365 subscription for our $120 a year or whatever it is, and we use Excel or Word or PowerPoint or Teams, all the products underneath that come with that subscription. We're very sticky, so it's a lovely annuity-like business, about half the company. We've always thought it would grow maybe mid-single digits. It's been doing better than that in history, but we don't like to be too optimistic. But something's changed with Gen AI, and they've produced a product they've called Copilot. They've trialled it with their top 600 customers so far, so we're talking really early days. But they've already started to talk about how they're going to price this product. So we've done some back of the envelope, a little bit of analysis around what could this mean for the earnings of that other half of Microsoft as we look down the pipe of it coming to fruition and being commercialised. If you said you would put Copilot, and Copilot is what it sounds like, it sits next to you at your desk on your computer, and when you can't figure out how to do something in Excel, it'll show you how to do it. So it's going to be super helpful. If we said Copilot is added to people's subscriptions at a rate of only 3% penetration, just 3 in every 100 take this on, we're going to add 10% to that part of Microsoft's business overnight. Now, I think penetration of this in time is probably going to be well north of 50%. So at 15, I'm already at another 50% of earnings. So we're talking this business ultimately could more than double in time as we start to get this commercialised. These are pretty compelling stories that stand behind why we have a very large position in Microsoft. Now let me talk about the transition to a net zero energy world, something that we are all having to execute across the globe, and something that will be fundamentally and profoundly important to how we're going to survive through the next few decades. On the left-hand side here, you can see where the carbon sources are today. Ultimately, this is about getting carbon out of our world, out of our atmosphere, back into oceans and soils. And so we've got to address these big chunky pieces aggressively, whether it's electricity and heat production, that's a lot about public utilities, transportation. Let's hope we're all driving electric cars in the next few years. Believe it or not, they're awesome. Whether we go down the path of changing the way industry is using fossil fuels and use more of these renewable energy sources. Lots of things we need to tackle. And to tackle it, we need to reallocate the world's capital stock. We need to move investments towards electrification of vehicles, towards fixing grid transmission, towards making buildings smarter around their heating and air conditioning, and of course, huge investments into semiconductors, because semiconductors are ultimately ultimately going to be crucial in getting the technology right that can solve many of these problems. To scale what we're talking about here, McKinsey's have put out some estimates, so have many others. They're all in large numbers, but essentially what we're talking about here is an increase in the spend on physical energy assets and land use assets. That's about 60% from where it is today. So adding another $3.5 trillion to spend every year to get us there. That's huge numbers. And you're not going to get there if we don't get governments involved. So government support is going to be crucial. And by support I mean things like taxes perhaps, but more importantly subsidies, and we're seeing that happen. And so, the government will drive the opportunity through policy for companies to see better returns if we go down this net zero path. That link between decarbonisation, automation and digitalisation are going to mean we can find much better growth opportunities as we look around the globe. I'm going to show you a few of the pathways that we see ways to monetise this and extract great returns for investors in our portfolio. Firstly, we have a business called Lowe's, a bit like Bunnings here in Australia. As we go down this path, we are still a long way behind, and climate change is hurting us every single day with fires and floods and consistent disruption to our urban environments in particular. This business is going to be there backstopping the repair work that continues to happen around climate change as we try to address this problem. Governments, as we've talked about, are obviously crucial to ensuring the capital flows will be in the right place. So the Green Deal in Europe, the Inflation Reduction Act in the US, there's policy around offshore wind in Europe, there's policy around renewable energy in Europe. Policy is going to keep coming at us, and that policy is going to say to companies, if you do this, we're going to give you a subsidy. Customers, consumers, if you buy an electric car, we're going to give you an extra few $1,000s to lean in that direction. So sure as eggs, it's going to drive behaviours to change. It's important, I'm sitting here talking to you about big, large addressable markets, but it's important to caveat this a little bit. Not all big, large addressable market opportunities come with great returns on capital. Sometimes you just end up with really commoditised industries. Important, things like solar, I would say, crucial for us to get there, but not necessarily a great place for us to make good returns for our investors. So we're going to be pretty careful about where we go chasing this stuff. We've talked about governments, but governments are going to empower private enterprise to go after this, and allocating private capital to the right parts of the market is going to be important. There's a huge piece of private capital that sits with institutions and superannuation funds that will increasingly be seeking where these opportunities are. And a business like Brookfield Corporation that sits in our portfolio is one of those companies that takes that money and reallocates it to the right places, clips the ticket along the way. So we like the returns that come with that. ASML, we've talked about it providing solutions around semiconductors. When we think about Gen AI, it's similarly crucial to what we're doing around the transition to net zero. And I think the other interesting thing, if you're starting to think about this stuff, is that as we look at what's going on in the world today, we're seeing the opportunities increasingly being in those parts of the market that are about technology and about the industrial complex, which is pretty broad, to be honest. And what's interesting there is when you're thinking about the industrial space, in history, we've typically thought about industrials as pretty cyclical. They do well when cycles are strong and they do badly when cycles turn the other way. They tend to have lots of high fixed capital investment. But because of the structural growth drivers that are sitting behind some pieces in the industrial space, we're seeing businesses that are priced for a cycle but actually have an underlying secular growth story that will probably see them maybe even miss out on a cycle this time round and for the next few years. So some interesting pieces that mean those businesses are sometimes really attractively priced. To leave you now, I'm just going to remind you, because I've got kind of in the weeds on just a couple of things. This is a very diverse portfolio. We are playing this across lots of different vectors. We get these opportunities in different parts of the market. And we are very much about that long-term orientation. So we like that resilient, dependable, predictable company, but we also like where we see those wonderful long-term growth opportunities that we can play through highly advantaged companies that will always stand us in good stead. So now I'm going to pass to my colleague Em. She's going to set you on fire with some very unique insights and some really interesting stuff from the restaurant space. Thanks, Em.
Thanks, Nikki. So I'm here to take you on a deeper dive into the restaurants industry. This is a sector that Magellan has been investing in for 15 years, and it makes up a really important part of our defensive sleeve of the portfolio. Restaurants offer us many of the characteristics that we're looking for in a core defensive holding. They give you pricing power, resilient demand profiles given their affordable value for money pricing, and they give you really high quality business models and management teams. However, what I hope to share with you today is that restaurants is not just a defensive play. And you've heard Arvid and Nikki talk a lot today about structural growth. And this is another sector where we think we have found a really nice structural growth story that we can invest in with conviction. So before I dive deeper into some of the unique aspects of this industry, let me remind you about the 3 restaurant companies that we own in the portfolio today and make up 11% of the global fund. Each of these 3 names offers us something slightly different. The first company we own is McDonald's. This is a highly predictable and dependable business. It runs a franchise model and it generates most of its earnings from a developed markets footprint. It has slightly less of a structural growth story just given how mature it is in those markets, but it plays its defensive role really well for us. And the team is executing superbly around the world under CEO Chris Kempczynski. The second company is Yum Brands. And this offers us a lot of the similar defensive characteristics to McDonald's with a couple of differences. Yum runs a multi-brand portfolio, and you will have heard us over the years talk about their brands KFC, Pizza Hut, and Taco Bell. It also grows a bit faster than Macca's, given that it generates a larger part of its earnings and growth from a large and diversified emerging markets business. And the final name on screen, Chipotle Mexican Grill, is a newer name that we added to the portfolio last year in place of Starbucks. Chipotle is a Mexican chain that serves burritos and bowls in a convenient quick service type model, but at a price point slightly above fast food. It is earlier in its growth cycle than the other names on screen. It's growing fast, and importantly, it's generating that growth from a North America market expansion story rather than a China growth story. It's a name that we've been following closely for many years, and were fortunate enough to find an attractive entry point last year when growth stocks in the market sold off more broadly. So investing in the restaurant sector gives us the opportunity to actually invest in 2 different types of business models. The first is a franchise model that we get exposure to through McDonald's and Yum Brands. In a franchise model, what we see is that these large restaurant chains actually partner with franchisee companies who operate the underlying restaurants and put down their capital to open new stores. What the franchisors that we invest in do is then clip the ticket on the revenues that all these McDonald's and KFC restaurants around the world generate. And that royalty stream is very high margin and comes with strong free cash flow conversion. Last year, we were particularly attracted to and lent into this type of business model in a highly inflationary environment. Our thesis was that these restaurant companies would see their revenue streams boosted by the strong inflation-driven pricing that I'm sure we all experienced in many parts of the consumer sector. But they actually didn't have any exposure they only had very limited exposure to the underlying food and commodity costs, where we were seeing the food, commodity and labour costs, where we were seeing this cost inflation pressure. And that thesis played out, and we saw really resilient earnings and actually expanding margins from these companies in a tough operating environment. The second type of business we have the opportunity to invest in is a company-operated model, and historically we've had exposure to that through Starbucks and now through Chipotle Mexican Grill. In this model, the companies are electing to operate the stores directly and put down their capital for growing stores. It can come with a slightly more risk than that ultra-defensive franchise model that we've spoken about. But if you find the right business, the right operating model and the right management teams, the returns that you can get from operating a restaurant are pretty incredible. What you're going to see on screen are the store economics of Chipotle Mexican Grill last year in 2022. The key takeaway here is that it costs this business around US $1 million to invest and open a new store. However, given the strong sales and margins that they get from these units, within the first year, Chipotle has repaid around 60% of that initial investment. And within 2 years, it has fully repaid that initial investment cost. Beyond year 2, these restaurants continue to exist and spit out really healthy volumes of cash that a business like Chipotle can use to reinvest in its brand and its technologies, to fund the next wave of store growth, or to return to shareholders through share repurchases. So now that we've covered off some of the 101s around the restaurants industry business models and companies, let's talk about the market and the outsized growth opportunity that we still see ahead. Around the world, the global limited service restaurant market is around a US $900 billion industry. But when you dig into the detail, it actually remains highly fragmented, with a lot of market share up for grabs for those companies we believe are positioned to win. Over the last 5 years, we've seen the largest restaurant chains take share of the broader market, and this is a trend that we expect to continue. There are multiple scale advantages that we see in this industry, and some of them will be pretty straightforward. These large chains have very sophisticated supply chains and really strong purchasing power to negotiate with their suppliers. This enables them to offer their products at the best value for money, and it's really hard to compete if you're a smaller chain. These brands have huge marketing budgets to put behind their brands to make sure that they stay relevant and part of consumer culture. And the final key advantage that we see that is only getting more important is in the digital and technology side of the business. If you think about opening and operating a restaurant today relative to 20 years ago, what consumers are demanding from you in terms of a technology standpoint has changed significantly. People want to order digitally, either on their phones or through kiosks. They want to be part of a loyalty program and get rewarded for coming back to these stores. And all of these types of technology solutions require a lot of fixed investment. And going forward, we believe that these large chains with their huge budgets are going to be best positioned to win. So some of these might sound straightforward, but maybe one interesting data point for you from the conversations that we've had with management teams over the years. When you reaching scale is actually quite difficult, and for them to get the economic flywheel working across all of these areas, it often takes them to get to around 100 stores before this all works. And sometimes taking the time it takes to get to 100 stores can be in the decades. These chains, given how far ahead they are in their growth stories, we really see that they're going to be difficult to displace going forward, and we really believe that this is an industry where scale matters. So let me get on to the structural growth part of this restaurant story. Unlike generative AI, the restaurant structural growth story from rolling out new stores isn't new or revolutionary. And in fact, it's something that we've probably heard us talk about since we first invested in the space back in 2007. However, it is an industry where we see that this same structural growth story still has many legs to run. And today I want to talk you through 2 examples that we see in our sector, in our holdings of Yum and Chipotle, that both offer us some attractive structural growth, but with a little bit of a different flavour. So let me start with Yum Brands. This is a stock that we have held in the Magellan Global Fund for 15 years. And over that time, it has returned a really attractive 13% per annum compound annual return for our investors. And this is really an example where this structural story has worked. Over the time that we've owned Yum, it's grown its business by 20,000 restaurants, from around 35,000 back in 2007 to 55,000 today. It's also become an increasingly global and diversified business, entering around 50 new markets since we've owned it, with now a presence in over 150 countries and territories today. But given all of this growth that we've been beneficiaries of, what gives us conviction that Yum is not only a defensive holding, but also still a driver of structural growth today? And that's really around the work that we've done on its large emerging markets business. You'll see on screen that in its home US market, Yum Brands has around 18,000 restaurants on a base of around 300 million people. or to use industry jargon, 54 restaurants per million people. In Yum's top 10 emerging markets, that metric today is sitting at 5, and we see a long runway for Yum to grow the penetration of its restaurants on a population base that's in the billions. But what gives us conviction that Yum can actually execute in markets like China and Indonesia and Vietnam? And it really comes back to the franchise model that I mentioned earlier in the presentation. When we talk about Yum brands rolling out new KFC and Pizza Hut stores around the world, what you need to remember is what's actually happening is that they are partnering with the best and most sophisticated operators that already have businesses in these markets, that know how to run the day-to-day operations and know how to take a KFC chicken brand or a Pizza Hut pizza brand and really tailor it to the local market and market that brand in a culturally relevant way. China has been a market where Yum has really lent in on this localised approach, and they've been successful in growing the penetration of their KFC and Pizza Hut brands as consumer incomes have risen and cities have urbanised. Today, there are 8 KFC and Pizza Hut restaurants per million of people in China, but 10 years ago that number was at 4. However, what really excites us about Yum is this is not just a one-country growth story. It has a presence today in India, Indonesia, and a really long list of markets where this exact same growth story is playing out. Last year, Yum Brands grew its unit base or its restaurant base by 6% for the year. And importantly, within that growth was over 100 countries contributing. And it's really that diversification of these growth engines that give us a lot of conviction that this growth story has a lot of legs left to run. So let's move to Chipotle, which is another exciting structural growth story, but with a different flavour. Chipotle's growth is coming from its home US market, where it has around 3,000 stores today. I showed you their economics before, but Chipotle has a proven brand and business model that already has really high brand awareness in the US. And what they're doing in their structural growth story is basically just rolling out these stores to different parts of the US to reach consumers that don't have access to the brand in their daily lives. To give you a sense of this company's brand awareness, as of last quarter, Chipotle had over 35 million loyalty program members signed up to its Chipotle Rewards program. That equates to around 1 in 10 Americans. This business is growing fast. It's targeting to grow stores at 8 to 10% per annum. And it believes that it can more than double its store base from around 3,000 stores today to 7,000 over the long term. And this is something that we see as really achievable, particularly when we consider where peer store footprints are today, of which some are still growing. But let me be clear, Chipotle doesn't need to take share from the McDonald's and the Taco Bells of the world to succeed here. Where their real share opportunity comes from is that really long tail of the really long fragmented tail of smaller chains and independent restaurants, where Chipotle can outcompete when it comes to food quality, brand relevance, digital, and convenience. So let's bring this back to the investment case. On screen, you will see the bridge to total shareholder returns that we believe that Yum Brands and Chipotle Mexican Grill can deliver over the next few years. It all begins with that highly predictable and reliable structural growth driver of rolling out new stores, which we expect to continue at the rate of around 5% per annum for Yum and around 8 to 9% for Chipotle. This isn't their only growth driver, however. These businesses are growing sales in existing stores, they're driving leverage on their operating and financial costs, and they're also very cash generative, which means that they can return cash to shareholders through share repurchases and dividends. Overall, we see this as a really compelling opportunity that also brings lovely defensive characteristics. So hopefully that has brought to life to you why this is a sector that we continue to love today, why we see an enduring role for these companies in the defensive sleeve of our portfolio, and why we get really excited if we do find the opportunity to buy into these businesses at attractive valuations. And with that, I'll hand over to Mark Jordan for Q&A.
Thank you, Emma, and thanks to Nikki and Arvid also. Some great information in that really does reinforce the investment approach and the philosophy that the Magellan Global Fund has followed for the last 16 years. We've shown you some of the detailed bottom-up company and industry analysis that we do, and combine that with those broad macroeconomic insights to construct a portfolio that's designed to deliver strong absolute returns through a variety of market cycles. So hopefully that to many of you is a consistent message and story. We're now moving to some questions for the team. As Mark Burgess mentioned, if you'd like to submit a question, please click on the button on the screen. We have had a number come through already. So I might fire the first one to you, Nikki. There's been lots of discussion about inflationary impacts of AI. What's your view on this?
Yeah, I guess the simple take is usually these things are very good for productivity. So if you're getting improving productivity, it takes pressure off labour markets. And over time, technology is typically deflationary, and we would expect this to play the same way.
Thank you. Perhaps a little bit more of a macro question for you, Arvid, just in relation to global growth and perhaps why it hasn't collapsed, given we've already seen a rapid escalation of interest rates.
Yeah, sure thing. I think this goes to why profits haven't collapsed as well. Look, I think you need to look at it by region, and I'll talk a little bit about the US, because I think this is where the global epicenter is. Interest rates have gone up, 500 basis points, 5 percentage points in the US, policy interest rates. And the reason why that really hasn't had a big impact on the consumer is because the channel which would impact the consumers would be through their mortgage debt. And most people almost everyone in America has a 30-year fixed mortgage. In Australia, it's 2 to 3 years. For them, it's 30 years. So they're not actually paying any more money here, right? It was locked in before. So if they're sitting there going, higher interest rates, it's not actually impacting me. So that's number one. So that's the first thing. The second thing I would say here is that during COVID, the US government was particularly charitable to its households, gave them a lot of money, and that money's in the process of being spent, okay? And what's really interesting here is that if you look at the spending of those, let's call them excess savings by income band, the lower income consumer, I think they've more or less spent all of that. So let's say that they've cracked in terms of their consumption. And the really big impact is going to be when the middle class, the middle income consumer and households, they start to pull back their spending because they've spent all the money, okay? I suspect that's probably in the next 6 months or so that you start to see that really start to come through. But the point being is it hasn't happened already, okay? So in the US, growth hasn't slowed because of those two things. In Australia, I suspect that both of those things are different. We have more variable rate mortgages here, so that's the impact of higher rates is going to be quicker in Australia versus the US. And the government, unfortunately for us, didn't give us as much money as the Americans got. So I think it'll be quicker to slow growth in Australia versus the US.
Okay. A follow-on question from that, and you mentioned in your presentation that there are currently no banks in the portfolio. Can you probably just give us a little bit more colour on the reasons for that?
Yeah, sure. So I think I always tell people, if you're going to get excited about banks and earnings, there's 3 things you've got to be excited about, or one of these 3 things. One is if you think interest rates are going up, because we all know that banks take your deposit and lend it out, and they can do it at a better rate when interest rates are higher. This is one of the reasons why we had banks a little while ago, because interest rates were going up. Now, I don't think that's the case right now. As I said earlier, I think the Federal Reserve and the Reserve Bank in Australia, they more or less told you that they're at the top of their interest rate hiking cycle. So I think that one there is not a positive, okay? Now, the second one would be if you thought that there was going to be a bunch of loans written, okay? So this is the banks growing their loan books. And because the economy is slowing, I suspect that loan growth is going to slow as well. So that's not really that exciting either. And the third reason to buy a bank or be excited about a bank is if they provision for a lot of loan losses and they don't happen, okay? So they've hollow-logged it, and so they're going to start giving you that money back. Now, those provisions are actually being built, not drawn down at the moment. So on all 3 of those metrics, they're not exciting for banks. Now, I was talking about earnings. You guys, I think people always say, Arvid, you talk about earnings, but what about the valuations? What's in the price? Now, I'm not sure that it's in the price, those risks, and particularly around the financial stability. I don't think you can get the high level of conviction that we require to say, I know that the credit cycle's not going to be a headwind here, and I know that there's not going to be a financial stability issue. Banks may be cheap on historical trading multiples, but you can't get conviction on those two things, which could be a very big issue for the banks and the profitability in the share prices.
Cheap assumes that E doesn't fall a lot and the earnings could fall a lot yet. So
Totally.
No, thank you. We've had a number of questions, I suppose, related to ESG issues on the fast service, quick service restaurants. How do you view the risks, ESG risks for those businesses in relation to health and wellness, Emma?
Thanks, Mark. Yeah. When we think about health and wellness, I think it's important to think about it as both a risk and an opportunity in the restaurant space. With the newest name that we've added to the portfolio, Chipotle Mexican Grill, they've actually really lent into health and wellness as an opportunity to build and have built their brand around it. They focus on only serving fresh ingredients that they're preparing every morning in the store. They no artificial ingredients, no artificial flavourings and preservatives. So that's something that they've lent into as an opportunity, and it's been really important to building a loyal brand following and to giving them pricing power going forwards. When we then move to the lower price point fast food names that we own, health and wellness is a bit more challenging, and it's not always what consumers are seeking these chains out for. But how they are managing this risk is by continuously innovating with their menus to make sure that they're staying relevant as consumer preferences change, that they're offering choice, and that they're being particularly proactive when it comes to high priority areas like a children's Happy Meal, for example. The Magellan team is actively engaging with these companies on sustainability issues like health and wellness, but also other issues like how they're managing their labour force and climate. And that last one in particular is one that we see a really important role for the large chains like McDonald's and Yum, being some of the biggest procurers of beef and protein in the world, to really use their scale to drive positive change going forward.
Thank you. One that's just come through now in relation to Visa, and this may well apply to the broader cards. A comment saying that we seem to be paying additional fees now to use Visa, and is this a concern that usage will be affected? But it's perhaps a broader question around the durability of Visa and Mastercard in the market. So perhaps. Nikki?
We're quite happy with Visa getting more fees. But big picture, Visa and Mastercard are extraordinary networks, and they have a network effect around them. So, they've got all the consumers on one side, they've got all the businesses on the other side. And we spend an inordinate amount of work watching what's going on in this space. There's always a lot of activity in the fintech space and innovation around the payments piece. But these solve most problems for people, and it's very hard to see new technologies or anything that is going to replace them or take them out of the position in people's wallets, whether it's a digital wallet or a physical wallet. The fees piece, actually over time, typically Visa and Mastercard are slowly paying less and less as a proportion of the revenue in fee, earning less and less. You pay less and less over time. So debit card fees and so forth have been coming down. Most people, to be honest, don't notice those things. So I'm impressed that someone does.
We've had a number of questions come through, I suppose, expressing some scepticism around net zero. And I know I have those same conversations with advisors on a daily basis. What are you hearing from companies in relation to net zero and what's actually happening?
This is a great conversation to have, I think. And what we find is that the scepticism around the plans that the world has to go down net zero is very heightened in Australia, and almost non-existent when you get into Europe, and then it's somewhere in between in the US, but increasingly the US is moving closer to Europe. So in most parts of the world, there is, and this is coming from the companies that we talk to, an enormous groundswell of people saying we have to move in this direction, and they are driving strategic and policy change to move us in that direction. What you need to understand, and what I want to make really clear, is us as investors do not have to have an opinion on this. I don't have to decide whether this is right or wrong, whether climate change is real or not. I just need to follow the money. That's ultimately what we think about. And if the money trail tells us that there is a huge opportunity here for us to create wealth for our investors, then we're going to do the hard work to figure out how we do that without taking too much risk. And as I mentioned, there's going to be parts of this that there will be, some say misplaced capital, but there will be capital that won't deliver a great return for sure. So we don't want to play there. So we're going to be very thoughtful, but we're not taking a view as to whether this is smart or dumb. We're just watching what's happening, and we know it's happening.
Thank you. One other that's just come through from the audience. Are we underestimating the economic malaise in the Chinese economy? And if yes, the impact on the global economy?
Well, I would say that the Chinese economy is something that we pay close attention to, and I think most investors should, by the way, given how big that economy is. Now, we are not going back to invest in domestic Chinese equities. I think we've been very clear on that in the past, which I think is a separate but similar type of risk. I think you've got to look at those two risks as separate. Now, when it comes to the Chinese economy and the Chinese economic outlook, our suspicion is that the Chinese authorities and the Chinese government, more particularly, is highly incentivised to stimulate growth, but they're not going to do it in a big bang fashion because, as we all know, there are some imbalances in the Chinese economy, and if they do a big bang type of stimulus, then it might inflame those imbalances which they've been working quite hard to try to reduce. So I think it's going to be an incremental and piecemeal type of stimulus that the Chinese government will implement. The question, I think, is when do they start doing it and exactly how big it is. But as to the downside risks of the global economy, it's clearly a downside risk, okay? But the political motivations and the economic motivations of the policy makers in China are clearly aligned with not making, or at least ensuring, that the global economy doesn't go south. You've got to remember here that the Chinese economy and the legitimacy of the Chinese government is based entirely on you don't get to vote, but you get some standard of living upgrades. And the Chinese economy is an export-driven economy. Okay, so they are highly incentivised to make sure that the rest of the world buys their stuff.
Yep, absolutely. We have time for one more question, and it's a fairly general question. We're in the middle of US reporting, and lots of companies have reported, still a few to come. Have there been any interesting results or themes that have that come out of the reporting season?
Well, I'll kick off.
Yep.
From my perspective, I think, it shows you that the economy is doing okay, and we sort of talked a little bit about this. And I would just make one point on this, which is, people talk about a recession, and they're really talking about real growth here, okay? What's the volume of stuff which is being sold or produced, okay? But with inflation being higher than it has been in the past, okay, it's come down, but it's higher than it is in the past, that means that the nominal amount of revenues or growth or profits which is out there is still higher than it otherwise would be, okay? And I think there's a little bit of this which is coming through. Of course, the consumer hasn't fully capitulated. There's still job hiring, which is going on. So I'd say that the resilience of the company results has been impressive from my perspective. We've all been waiting for them to turn, or at least to slow in profit growth. Hasn't happened yet.
Maybe
final comment, Nikki.
Yeah, maybe just to add on to that, I would say there's been a couple of words that have continued to be dominant in this reporting season. One is resilience, business resilience, consumer resilience. That's what I was talking about. So companies are still talking about that a lot. We're obviously looking forward, so interesting looking back that it is still very good. AI is the other one, of course. And, people are really focused on what they need to do to make sure they don't get disrupted by this, but also capitalise on the opportunity. So too early for it really to be formative, but definitely companies are thinking about this, whatever their business is. So, I think we obviously have a narrow field of view. We don't look at the whole market. We look at our portfolio and we look at our best ideas, and we look a little bit beyond that with the team at things that are showing us data points in the environment that we're in. And it continues to look like a pretty solid backdrop for companies. Nominal GDP growth is still very good, but most signs say inflation is coming down, and we'll see how bad the growth gets.
Wonderful. Thank you, everyone. In the interest of time, we might wrap it there. For questions that were put forward that we didn't get to, we will get back to you and respond in the coming days. Thank you for those that joined us live today. We are recording this webinar, and it will be posted to the Magellan website in the coming days. And we would encourage you to share the recording of this with clients, with colleagues, or with friends. There's some valuable insights there to be shared. For those that are watching and require CPD points, we will send you out a feedback form. We ask you to complete that feedback form, and in return, we will send you a CPD certificate. If you have any further questions, please contact us here at Magellan, and we'll be happy to talk to you. Thanks for watching.